So when Francisco and I talked about this, he said, why don't you tell them a little bit about Silicon Valley maybe from a different perspective than what they've heard before. So first, let me say, this says I'm basically a corporate venture capital person. That's where my strength is. I've had some interaction with the financial folks, much more with angel investors and corporate venture capital people. I've been in that space a lot. So what I'd like to say about Silicon Valley firstly is that it's not as perfect as some people here seem to think it might be. There's a lot of what those of us who are living there think of as vultures circling around wanting a piece of you. And they're not, some people refer to venture capitalists as vulture capitalists, but the venture capitalists, it's fairly easy to understand what they want. Some of the others, it's a little harder to understand. But basically, if you look at it from the startup perspective, the startups have the same sorts of complaints you hear over here. The startups would like to have more funding, they'd like to have less conservative investors, they'd like to have easier access to experienced staff, they'd like a less dysfunctional ecosystem, they'd like a better economy, they'd like better legislation for things about taxes on options and so forth. So it's really the same group of complaints that you hear from startups here. It's just a different environment. And so one of the points I want to make to you today is that a good startup, wherever they are, figures out what the economy is, figures out how to make the local system work for them. And the same for an investor. A good investor, wherever they are, figures out what the local system is and figures out how to make that work for them. And so it might be a little harder to start a fabulous semiconductor company here in Portugal because the ecosystem wasn't so great. But at the same time, if you wanted to start a mold-making company such as your country knows so well, you probably wouldn't try to do that in Silicon Valley because you wouldn't be able to find anybody who understood what you were talking about. So you need to think about the local context. It's not a good place to start some kinds of startups or to get some kinds of startups funded. So for example, several years ago, I was chairing one of these startup showcase events where startups get up and present to investors, and the investors see if they're interested in investing. And whoever had screened the people who were presenting decided somebody was very interesting, so they let them do a presentation, which is really a mistake for everybody. This was a group of people who wanted to sell model horses. They were about this high. They cost about $400. They were aimed at teenagers. And they had impressive credentials to do this. But they were presenting this to a group of people who primarily understood the internet and software and semiconductors. And so it was a real mistake. And in my view, they would have been better off in Los Angeles or New York than in Silicon Valley. I really didn't understand why they were there. Plus, their lawyer didn't understand the system. He had allowed angels to invest with a term sheet which no informed group of angels or venture capitalists would work with. They would basically say, you've got to rewrite it all at your expense or we're just not going to bother to invest. So think about Silicon Valley as a place which does some things reasonably well and does other things less well and really doesn't do a number of other things, some of which you may think are happening there. Also, the strengths historically are in, say, semiconductors and software, and obviously there's a lot of strength in the internet these days and in the mobile app space. But if you look at, say, biotech and nanotech, you see centers of activity all over the world. And so Silicon Valley's advantage in biotech and nanotech is really much, much smaller, if at all, in comparison to other places where you might be. And we're really in sort of a world ecosystem there where in some cases the investors will expect you to be international from an early stage, and in others they will expect you to just grow the American market first and be successful there before you go international. But a few years ago, for example, one of the major nanotech investors was saying, I won't invest in a nanotech startup unless they're doing their research in either India or China, where the research is a lot cheaper. So life is a little different, perhaps a little more complex than some of the things you might have heard. The Congress is always changing the tax structures. I've spent a lot of money over the last 20 years trying to understand under what conditions I could accept options for compensation from a startup without getting taxed when I received the options. And the way you do that has changed multiple times in the last 20 years as Congress on the one hand and the state legislatures on the other hand keep changing the legislation and making that more complex. We, in the United States, the tax structure is much more complex than it is in Portugal. The effective tax rate may be lower, but you're going to have to pay an accountant a lot of money in order to achieve that. So I would suggest to you that investors anywhere, and of course I'm particularly going to talk about Silicon Valley, but my experience includes Chicago and Washington, D.C., and some of London, as well as a little of here. The investors want to invest in a CEO with experience and leadership skills. And what they would also like to not invest in a prima donna. So for example, I had a client who invested in a very smart guy. This is a world-class technical mind who really understood something about security. But he was a real prima donna. He wanted to do everything his way. And so the initial set of investors lost interest in putting up with that. So he couldn't get any more money from them, and the word was getting around the valley, so he couldn't get any money from anybody else. And finally, somebody decided, okay, we're going to put up with this, so we're going to put new money in. So this is what we call a cram down. In other words, the previous investors or stockholders who had owned 100% of the company now get crammed down where they own maybe 10% of the company. And the new investors come in and own 90%, or, you know, these are all approximate things worked out in the restructuring process, which is best described as sort of a macho game where the different people who have the technical skills or the money or the belief, you know, are on different sides of the table trying to figure out who gets to win. And so this new investor took over, and he put up with the guy for about 1.5 years, and then he couldn't stand that anymore. And so he backed out, and then a third set of investors came in. So in each case, of course, they had to keep on giving the prima donna money in order to keep him being interested, and everybody else got washed out and was, shall we say, less excited. But ultimately, they got a product to market after a lot of carnage and blood on the floor. But the guy was, shall we say, not well liked. And most of the successful people are, they may not be loved, but they're liked a lot better than that. Teams, obviously you'd like an ideal team in terms of what's strong, that's appropriate to the business. So if you're trying to start a medical device and the exit is to be acquired by a pharmaceutical company or somebody else in the medical space, because they have the installed infrastructure for selling to doctors and hospitals, then you don't have to put the same sort of team in place that you would have to put in place for, say, an internet commerce-based marketing play, which was all marketing-based. So the early investors want to see the teams that are strong in the ways that are important at that time, and the CEO with the ability to grow that. Now, in Silicon Valley, there's a typical investment cycle, which is 2 rounds of angel investment, and then maybe 3 rounds of venture capital investment, called an ABC, and then hopefully you have an exit. At the end of the B round, the venture capitalists plan on having control of the company. In other words, they're going to have more than 50% of the equity. And they're also going to look at the CEO and the other key officers at that point and decide whether or not they want to replace them to have the right people in place for the exit. If you're going to do an IPO exit, this is probably more important than if you're going to do an acquisition exit. But nevertheless, if the play is to be sold to a very demanding acquiring company who's spending a lot of money, they want to have the right team there. So they're going to replace people. And so I was working as a consultant to one company where about a year before their IPO, they fired the CFO, and then 6 months later they brought in a VP of finance above him. And then 3 months later, this is only 3 months before the IPO, they fired the executive vice president of product development, and they brought in another guy. And this was all because they were trying to make everything look right just for the roadshow. The investors are really looking for business plans that are disruptive but not too disruptive. In other words, if it's too disruptive, they're concerned that it's going to be harder to sell to the marketplace. So for example, one of the first reprogrammable chips was developed by an industry leader who had a tremendous reputation. He put in about $50 million of his own money, but he couldn't get other people to believe in it. He put in about another $100 million of his own money. And what he really proved after spending about $150 million was that the market wasn't ready to buy it. And this is an indication of how the investors want things disruptive but not too disruptive. As one of them said, being early is the same as being wrong. Most investors in Silicon Valley don't invest unless they're introduced to the CEO, startup CEO, by somebody they know well and they trust, because that's part of their due diligence process. So in other words, if you just email a business plan to somebody, it'll go in the pile, and the chance of anything useful happening with it is very low. Most of them won't tell you why they're not investing. They just smile politely and walk away. And I think part of the reason for that is I've been present when some investors said why they weren't investing. So I happened to be in the room where a highly respected investor, he was a former Gillette executive, was explaining to a startup CEO why he was not going to invest. And he said, well, I like to invest in stealthy startups where nobody else knows what's going on, so that we have our strategic competitive advantages as long as possible. And he said, you've given your business plan to everybody that I know in Silicon Valley. And so everybody knows, and if anybody thinks they could give $1 million to somebody else and do it better, they're going to do that because they can make the decision whether that they can do it better than you can. And he said, you have to understand that I'm putting together a short list of investments about once every 2 months, and there's 3 or 4 startups on that list, and then I'm going to choose the best one, and then I'm going to throw the rest of them away, and then I'm going to start developing a new short list. And so he said, I'm going to invest in another sector that's quite, in this particular time frame, I'm going to invest in another sector that's quite unrelated to yours, but where the product is very stealthy and where I see a much more compelling case for success. So, as I mentioned earlier, I believe that either a startup or an investor looks at the current environment they're in, and they look at what's going on and they decide how they can work that system. They want to develop as much advantage as they can. They want to have the local system working for them. They want to understand best practices from other parts of the world that they might bring in. They want to think about exports or growing internationally. So, for example, the things that George said yesterday about he thought that India and China made it had less resistance to what an entrepreneur needed to do in order to be successful. I suggest to you that I agree with that, and I think that it's interesting to watch that, even if it's in a different sector than you're in. It's useful to see what they're doing and see what you can learn from that about how things might be better. Because in a complex world, and we've certainly got a very complex world this year, in a complex world you need all the understanding and advantage you can get. And so I just offer that George gave some really good advice there. Thank you very much.